Hi, Assalamualaikum. My name is Fatah Inshiram Tifar Ali and I will explain about hedging. So, what is hedging? So, hedging means protection and also a strategy that used to minimize potential losses from investment or other financial positions. Next, we move to the question that we have discussed together, and we take the question from the past question June 2016. And the question says that BBM Bank plans to adjust its bond portfolio holdings and is therefore very concerned about the rise in interest rates. It plans to sell 50 million ringgit of lower yielding 5-year MGS in its portfolio, and the rise in interest rates will push the MGS price down. And it is now May 2016, and the current interest rate is 4%, and the FMG5 September future contracts is trading at 108. So for the first question is, describe the strategy that the bank should undertake to avoid selling its existing 5-year MGS at a low price. And the second question is, if in June 2016 the interest rises to 5.5% and the FMG5 is priced at 106, show the effect of the BBM Bank's hedging strategy. Next, we move to the answers for the question 1, which is to describe the strategy that the bank should undertake to avoid selling its existing 5-year MGS at a lower price. The answer should be the bank should apply hedging method because they expect the interest rate to rise and they intend to sell their bond portfolio and the price of bond will decrease. Therefore, they should do the short hedge today. Next, we move to the answer for the question 2, which is if in June 2016 the interest rises to 5.5% and the June FMGS is priced at 106, show the effect of the BBM Bank's hedging strategy. So for the first step, we must conclude the find or the money, today cash market interest, today future market interest, later cash market interest, and the later future market interest. So for the find money, we have the 50 million ringgit. Today cash market interest, we have the 4%. Today future market interest, we have 108. For the later cash market interest, we have 5.5%, and the later future market interest, we have the 106. So for the next step, we must calculate the number of contract. So for the formula, number of contract for the MGS is find divided by contract size. So 5 million ringgit divided by 100,000 ringgit, and we get the 500 contracts. Next, after we calculate the number of contract, we must do a table which include the date, today and later, and cash market and future market. So for the cash market today, we expect to sell 5 million ringgit of 5 years MGS in May at interest rate 4%. And for the cash market later, we sell the 5 million ringgit of 5 years MGS in June at interest rate 5.5%. For the future market today, we sell 500 September FMG5 contracts at 108. And the last but not least, for the future market later, we buy 500 June FMG5 contracts at 106. Okay, after we do the table, we must calculate the future position. So future position include profit or loss. So for the formula, selling price minus buying price times 100 basis points times number of contract times 10 ringgit. So we have 108 minus 106 times 100 times 500 times 10 ringgit. So we get the 1 million ringgit. Next, after we calculate the future position, we must calculate the cash position. So cash position divided by 3. So for the first one is cost of purchase, which is the formula is ending index divided by beginning index times bond value. So 106 divided by 108 times 50 million ringgit. So we get the 49,074,074 ringgit and 7 cents. Next, we must calculate the net effect. So the formula is profit or loss plus cost of purchase. So 1 million ringgit plus 49,074,074 ringgit and 7 cents, and we get the 50,074,074 ringgit and 7 cents. Okay, so last one, for the cash position, we need to calculate the effective price. So for the formula, net effect divided by bond value times ending index. So 50,074,074 ringgit 0.7 cent divided by 50 million ringgit and times 106. So we get 106.16. Okay, last but not least for the explanation. So the hedging is effectively helps BBM Bank to sell the bond of 5 years MGS at higher index, which is 106.16 instead of 106 without hedging. That's all from me, and I will pass to the next presenter.
Assalamualaikum, my name is Siti Nurfatiha Buti Samsudin, and I'm going to explain about the next futures trading strategy. The next futures trading strategy is arbitrage trading. Arbitrage in futures trading involves exploiting price difference between related financial instruments or market to make a profit with a minimal risk. Basically, traders look for price divergence between a futures contract and its underlying asset or between different futures contracts. As in my knowledge, basically there are two types of arbitrage. The first one is cash and carry, and the second one is reverse cash and carry. So, the question that we chose for the arbitrage strategy is from question past year July 2017, question 3. The question is, today 1 March 2017, Ms. Bella believed that cash and futures price of nation's stock market are mismatched, and hence she wished to take an arbitrage opportunity on this market situation. Currently, KLCI trade at 1,660 points, while May FKLI quotes at 1,695 points. She already arranged for 3-month borrowing of 1 million ringgit Malaysia with CBC Bank at 7.5% per annum, and expect to receive an average dividend yield of 5% from the portfolio. If the price converges at 1,680 points, show the arbitrage strategy transaction and its profit. So from the question, we can get the main information or the main data that we must to determine to calculate the arbitrage strategy. What is the main data is we must to know fund or money, today cash market point, today futures market point, later cash market point, and the last one is later futures market point. So the fund or money that we get from the question is 1 million ringgit Malaysia. Today cash market point is 1,660 point. Today futures market point is 1,695. Later cash market point is 1,680, and the last one is later futures market point is 1,680. It's same with the cash market point because the price is converged. So if the price is converged, then later cash market point and later futures market point, it will be the same price. Next, what we're gonna do is we must to know and determine the duration of the trading until the maturity date. How? We must to calculate from the beginning of strategy, which is from the month, from the March has 31 days, April 30 days, and May 31 days. So the total of the duration of the trading until the maturity date is 92 days. And next, we must to calculate the NOC. NOC is number of contract. So how to calculate the number of contract for the FKLI and KLCI is amount to portfolio multiply percentage of arbitrage multiply with beta of the investment and divide by value of contract. So from the question, we can calculate the NOC with the amount is 1 million ringgit Malaysia multiply with 100% because the percentage of arbitrage is 100, then multiply with 1 because the beta of the investment in FKLI is 1, then divide with value of contract. The value of contract is 1,695 multiply with 50. Then we can get the answer is the number of contracts for the this question is 11 contracts. Next, what we must to know is we must to know about two steps to calculate arbitrage strategy. The first one, we must to determine the fair value price. Second, we must to compare the actual price with the fair value price. And the last step is we must to calculate the arbitrage profit. So, how to determine the fair value price with the formula is spot price multiply with 1 plus R minus T and multiply with T divided by N. R is stand for the interest rate, D stand for the dividends, and T divided by N is stand for D to maturity. So from the formula we can calculate, then we can get the answer with RM 1670.36 cent. Then the second step, we must compare the actual price with the fair value price. Then we from the comparison, it is actually the actual price is more than the fair value. So we can conclude that based on the fair value model, May FKLI should be traded at 1670.36 is actually in true price and not at 1060.95, which is in actual price, as May FKLI is overpriced. Therefore, we must to sell May FKLI and buy physical stock KLCI in the cash market. So that's the conclusion that we can get from the fair value and the actual price. So then in the table we can analyze that in today March in cash market, buy KLCI worth 1 million ringgit Malaysia at 1660 point and hold temporarily. In futures market, it sell 11 May FKLI contract at 1695, and for the later, which is in May contract in cash market, it sell KLCI worth 1 million ringgit Malaysia at 1680 points, and for the future market, it buy 11 May FKLI contract at 1680 points. So for the last step to calculate arbitrage strategy is we must to calculate the arbitrage profit. So the first one, we must to calculate the profit in futures market. Then we must to calculate profit in cash market. So for the futures market, the formula for profit or loss is selling price minus with buying price, then multiply with number of contract and multiply with 50. So then we can get the answer is RM 8250 for the futures market. For the cash market, we must to calculate increase in value, interest expense for borrowing 1 million ringgit Malaysia, and dividend received. So for increase in value, the formula is ending index minus with beginning index and divide with beginning index. Or then the last step is multiply with fund. So we can get the answer for the increase in value is 12,048.19 cents. So then we must to calculate the interest expense for borrowing 1 million, which is how to calculate is 1 million multiply with 0.075, then multiply with 72 point divide by 365 days. So we can get the answer for the interest expenses is 18,904.11 cents. And the next one is we must to calculate the dividend received. So the dividend received is 1 million multiply with the dividend and multiply also with the duration period, then we can get the answer 12,602.74 cents. Then the last one is we must to calculate the gross profit from the futures market and cash market. So how the gross profit is from the profit or loss in futures market, we plus with the increase in value and minus with interest expenses for borrowing and plus with the dividend received, then we can get the answer is 13,996.82 cents.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Atika binti Mustafa Kamal, and today I would like to explain you about spreading. So what is spreading? Spreading in futures trading refers to a strategy where an investor simultaneously take both a long and short position in related contracts. This approach aims to profit from price difference or changes in the relationship between the chosen financial instruments. Traders may spread within the same commodity by selecting different delivery months or across related assets, seeking to manage risk and capitalize on market dynamics. We have agreed to choose question 3 from June 2014 past year question, which is FKB3. The question already gives us the information, which is type of contract and the price. By looking at the price above, the yield curve is inverse. A trader believes that yield curve will normalize and he wants to create a spread trade for June and September 2014 contracts, which later closed at 94.31 and 94.18 respectively. There are 3 questions, which is the first one, describe how he could create a profitable spread trade for 10 June and 10 September FKB3 contracts. The second one is calculate his profit and loss for June contract, and the third one is calculate his net profit or loss from doing the spread trade. To answer this question, first we need to extract the important things. From the table given, this is the information that we got. Today June 2014 FKB3 94.18, later June 2014 FKB3 94.31, today September 2014 FKB3 94.29, and later September 2014 FKB3 is 94.18. Okay, so from the question 1, it already stated that the total contracts for both June and September FKB3 2014 are 10 contracts. So if we look at the FKB price trend, it shows a bullish trend. Therefore, the trader should buy June 2014 FKB3 with 94.18 with a low price and sell September 2014 FKB3 with 94.29 with a high price. To make it easier, we have to draw a spreading table for June and September 2014. After that, we can proceed with trading profit or loss. First, we calculate profit or loss for June 2014 FKB3. To calculate the profit loss, the formula is selling price minus buying price times with 100 basis point times with number of contract and times with RM25. Based on the table, we can calculate the profit loss, which is the answer is RM 3,250. Next, we calculate the profit loss for September 2014 FKB3. Same goes with the first calculation. We use the same formula and the answer we got is RM 2,750 ringgit.
Hello everyone, I'm Nisa. I will continue the topic of speculation as a trading strategy in the field of financial markets. Speculating refers to the act of engaging in financial transaction with the primary goal of making a profit from price movement. Individuals or entities involved in speculation, often referred to as speculators, attempt to forecast future price changes in financial instruments such as stocks, bonds, commodities, currencies, or derivative and take position accordingly. Here is an example. Mr. Alex is an active investor in commodity futures. He normally takes advantage from any news that give the opportunity to do speculation. Today, 18 August 2017, he expects the price of CPO to enter a downtrend. Spot price and futures price of CPO for 18 August are 2725 ringgit and 2734 ringgit respectively. Mr. Alex needs to pay an initial margin of 8,000 ringgit per contract and a maintenance margin of 6,000 ringgit per contract. Based on the information below, calculate the variation gains or losses and total profit or loss if he decides to close out on 23rd August 2017, assuming 5 contracts. We have highlighted all the information given. First of all, we need to calculate the initial margins and maintenance margin for the 5 contracts. The new initial margins is 40,000 ringgit and maintenance margin is 30,000 ringgit. Mr. Alex initially sold on the first day and recorded a current margin of 40,000 ringgit. Over the following days, there will be floating profit or loss. The calculation method is selling price minus buying price times the number of contracts times 25 metric tons. Mr. Alex will experience gains and losses in the floating profit or loss column influenced by the changes in closing prices. The current margin fluctuates based on the cumulative impact of these daily changes, reflecting the trader's overall financial position. Therefore, the current margin on the last day is 41,125 ringgit and he will get a profit of 1,125 ringgit if he decides to close out on 23rd August 2017. But what if on 23rd August 2017 the closing price is 2,738 ringgit? Will he experience profit as well or vice versa? Based on the calculation, Mr. Alex will suffer a loss of 500 ringgit. It is important to note that speculation is distinct from investing. Investors typically focus on the long-term fundamentals of an asset, seeking steady returns and income. Speculators, on the other hand, are more concerned with short-term price movement and capitalize on market inefficiencies. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. I am Najib Binti Muhammad Ranzi and I will explain about the basic option and synthetic option. Okay, firstly is about the meaning by the basic option and synthetic option. First is an option is a contract that give by the buyer the right without the obligation to buy or sell the underlying asset at the assessed price until their maturity of contract. On the other hand, the seller has an obligation to sell or to buy their underlying instrument only if they assess the price by the buyer. Meaning that the buyer has to pay deposit in order to acquire a right, while a seller will receive a deposit in order to place him in an obligation. Okay, we move to the question for the basic option, which is June 2015. Question 5. A. For each of the following scenarios, state whether the option is in the money, out the money, or at the money, and justify the answer. First, you have a KLCI call option with a strike price of 1,840 and the current index level of 1,875. 2. You have an ABC put option with a strike price of RM2 and 50 cent and the current share price is RM2 and 25 cent. Third, you have a KLCI put option with a strike price of 1,880 and the current index level is 1,910. Fourth, you have an ABC call option with a strike price of RM8 ringgit and 50 cent and the current share price is RM8 ringgit. For the answer for 5A, for the number 1 is current market price is more than the strike price, so it was a call option and it in the money. Second is the market price is less than the strike price, put option, and the answer is in the money also. Third one is when the strike price is less than the market price, which is a put option and out the money. And lastly, the market price is equal to the strike price, call option, and the answer is at the money. Okay, B. Assume that the KLCI is currently at 1,850. You buy 100 March of 1,850 KLCI call option at strike price of 98 and 100 of March 1,850 KLCI put option and the same strike price of 98 and hold until the expiry
Assume there are 71 days to expiry. First, state the most appropriate name for this position. Second, indicate two market situations in which this position can make money. Third, determine the profit, loss and break-even at expiry. And lastly is draw an expiry profit diagram for this option. Okay, for the answer, first market price is 1,850 while the strike price is also 1,850 and the answer is at the money. Second is a long call. We as investor buy a call option when we expect the market to be bullish and we have the right to buy the underlying asset. And another one is long put. We as an investor put a put option when we expect the market to be bearish and we have the right to sell the underlying asset. And that's the answer that we choose. Okay, next is for the profit, loss and also break even. The answer for the long call is profit we got negative 98 while loss is 98 profit and break even we got 1,948 while for the long put we got the profit for also negative 98 and loss for 98 and the break even is 1,752. Next, for the diagram, for the payoff diagram, for first is a long call. We can see here we got the profit and loss at the negative 98 and at the below for the current market price margin is limited loss with price market 98 and the exercise price of 1,850 while for the at the above is the unlimited profit and the intervene between those is break even at 1,948. For the long put is a reversal from the long call. At the left we got the unlimited profit while at the right below we got the limited loss with 98 negative and at the interval we got the break even which is 1,752 with the exercise is 1,850. Okay, next we move to the synthetic option question which is December 2014 and also question number 5. The question is the following is the information about the call and put option available on Tenaga Hebat Berhad shares. A call option with the exercise price of RM7 and a premium of 80 cents. Second is a call option with an exercise price of 8 ringgit and a premium of 40 cents. And lastly is a put option with an exercise price of 7 ringgit and a premium of 40 cents. A put option with exercise price of 7 ringgit 50 cents and a premium of 60 cents. From the information above, you are required to create a long straddle, draw the pair of diagram with proper labels, and lastly is state the maximum profit and loss of the strategy. Okay, for the answer, for A1 is a long straddle. First, we buy a call option with the exercise price of 7 ringgit and premium of 80 cents. 2, buy the put option with the exercise price of 7 ringgit and the premium of 40 cents. For the answer is as below, and we got the loss of RM1 ringgit and 20 cents. Okay, for the payoff diagram as stated above, there are long call and long put, and we got the break even of 7 ringgit and 80 cents for the long call. For the long put, we got the break even of 6 ringgit and 60 cents. And here what we can get from the payoff diagram. First is break even put option with the total of 5 ringgit and 80 cents. Break even for the call option, we got 8 ringgit and 50 cents, and lastly total premium paid we got loss for 1 ringgit and 20 cents. Okay, for the third question we got loss RM 1 ringgit and 20 cents. Profit we got X is less than RM 5 ringgit and 80 cents. Third is profit equals to X is greater than the RM 8 ringgit and 20 cents, and lastly RM 5 ringgit and 80 cents we can conclude is greater than X and is greater than 8 ringgit and 20 cents. Okay, next is for the question B. We need to create a short straddle, which is firstly we need to write a call option with a price of 8 ringgit and the premium price of 40 cents, and secondly we need to write a put option with a start price of 7 ringgit 50 cents and also the premium of 60 cents. Here we can get a short call plus also short put, and we can get the premium of 1 ringgit. The profit equals to 1 ringgit, loss equals to X less than 6 ringgit and 50 cents, loss equals to X is more than 9 ringgit, and lastly is RM 6 ringgit and 50 cents is larger than X and larger than 9 ringgit. First, from the break even for the put, we got the RM 6 ringgit and 50 cents, and break even for the call, we can got 9 ringgit, and total payment received is 1 ringgit. Okay, here also we can see the diagram for the calculation, how we get all the answer. And lastly is the rate of diagram for short call and short put, which conclude as short struggle. And at the left side, we can see the exercise price of put option, which is RM7.50 with the break even of RM6.50. And at the right side, we can see the exercise price of call option, which is RM8 and the break even of RM9. Okay, that's all from me. Thank you.